You know that feeling, right? That quiet moment just before the market opens. You've done your homework, you've placed your bets, and now you just have to wait. It's this crazy mix of hope and anxiety. And for one trader, that entire feeling was summed up with one simple little wish. And well, it looks like the force was definitely with this one, because when those opening bells rang, what they saw on the screen was pretty much a trader's dream. So what happened? How did we get here? Okay, just look at this for a second. An 80% gain on one trade and almost 68% on another, all overnight. I mean, these are the kinds of numbers that make your heart pound. But here's the thing. These two trades were totally different animals with completely different risks. So the real question is, how did this happen? And more importantly, what can we learn from it? All right, let's start with the big winner, that IBIT call option. This was a classic directional bet. It's really simple. The trader was betting the stock's price would go in one direction and one direction only, up, and they were betting it would happen really, really fast. So what exactly is a long call? Well, think of it like this. It's kind of like putting a small deposit on a house you think is going to skyrocket in value. You pay a little bit up front for the right to buy the stock at a set price later. If that stock price explodes, your tiny investment can suddenly be worth a whole lot more. It's all about leverage, right? Using a small amount of cash to control a much bigger asset. Now, here's where it gets really interesting. Look at the setup. This trader bought 18 of these contracts, and they were expiring in just a couple of days. The performance? Absolutely spectacular. That 80.6% gain in 24 hours. But here's the reality check, the fine print. With so little time left, these options were dealing with something called extreme theta, or time decay. And that's the perfect way to think about it. The biggest risk here was time decay. Every single second that ticks by, that option is losing a little bit of its value, just like an ice cube melting on a hot day. And the closer you get to that expiration date, the faster it melts. So even if the stock price doesn't move an inch against you, you're still losing money. It's a race against the clock. Okay, so now let's switch gears and look at the second trade. This gives us a totally different picture. This wasn't a simple, I hope it goes up bet. Nope, this was a carefully engineered, high-probability play on Tesla. So what in the world is a bull-put spread? It's a completely different way of thinking. Instead of paying money for an option, you're basically selling an option. Think of it like you're the insurance company. You get paid a premium up front, and you're just betting that the stock will stay above a certain price. As long as it does, you just get to keep the money. The catch? Your profit is capped, but your chance of winning is a whole lot higher. The setup here was pretty slick. The trader collected $160 just for taking on this bet. And the performance was amazing. They captured almost 68% of their total possible profit overnight. But the reality? Whoa, this was even riskier than the IBIT trade. Because this option expired the very same day, it had something called extreme gamma risk. A tiny little dip in Tesla's price could have completely vaporized that entire gain in a blink. And all of this brings us to the most critical parts of any trade. It's not about getting in. It's about knowing when to get out. You're up big, you're feeling good. Now what do? This is, without a doubt, the million-dollar question every single trader has to face. And the answer to that question really depends on what kind of risk you're holding. On one side, you have the IBIT trade with theta risk, that slow, predictable, melting ice cube. On the other side, you've got the TSLA trade with gamma risk, which is like an unpredictable, explosive time bomb where one wrong move in price could blow everything up. Just to make this feel real, that 80% gain on IBIT was about $168 in profit. It's not just a percentage on a screen, it's real cash sitting there. So with that in mind, what were the choices? The trader basically had two really smart options. Option one, just close the whole thing out, take that fantastic 80% win and call it a day. Or option two, a little more advanced, sell most of the contracts to lock in your profit, but let a couple of them, what traders call runners, ride, just in case the stock keeps going up. It's like playing with the house's money. But for that Tesla trade, with that insane gamma risk, there was no debate. It's so important to understand this. When you're playing with same-day expiration options, a 67% overnight gain isn't a sign to get greedy. It is a giant, flashing neon sign that says get out. You take that win and you do not look back. So after breaking all this down, what's the big picture? What does this masterclass in trading and risk management actually teach us? Let's boil it down to the absolute key takeaways. So what have we learned? First off, huge wins like this are rare. They're the exception, so you have to treat them that way. Second, you have to know what kind of risk you're dealing with. Is it a melting ice cube of theta or a ticking time bomb of gamma? And maybe the most important lesson of all, the pros have an exit plan before they even hit the buy button. They know that banking a great win is always, always smarter than gambling for a perfect one. Which leaves us with one final thought. It's easy for us to sit here and analyze this after the fact, right? But in the heat of the moment, what would you do? You're up 80% in a day. Do you cash out and lock in that amazing profit? Or do you risk it all, just to try and squeeze out that last 20%? The answer says a lot about you and your own strategy as a trader.